Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin and the most recent CPI report. Headline inflation went up from 2.7 to 2.9% in line with expectations. Core CPI dropped from 3.3% to 3.2%, which was slightly better than expectations. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, one of the things that I've mentioned quite frequently over the last few weeks was that with the labor market, good news is bad news. But as I mentioned on Twitter yesterday, make sure you follow me there if you don't. Good news should be still considered to be good news. And the reason for that is if you think about our discussions with the 10-year yield and how as it goes up, it's a headwind for risk assets. The reason it was going up was because the labor market was doing pretty well. And so the market had to ask itself the simple question, well, if the labor market's doing okay, why is the Fed cutting so much? Because if you remember, the 10-year yield started to really go up right when the Fed began to cut rates. This right here, you see that? That was September. That's exactly when the Fed began cutting rates. The 10-year yield has done nothing but go up since the Fed started to cut rates. So, in that sense, if the unemployment rate is dropping, right? If it's dropping or staying flat, then, or initial claims, right? Initial claims have been dropping. As long as the unemployment rate isn't skyrocketing, the market has to then ask, why is the Fed cutting with a labor market that's okay, but inflation's starting to go up, right? Starting to go up. If you look at inflation year over year, you can see that basically it bottomed in September when the Fed started to cut. And now every month since then, the inflation rate, headline inflation rate, has been going up, right? It bottomed at 2.41%, then 2.58, then 2.73, then 2.9. If you look at a monthly change of inflation, you can see that it bottomed out. The lowest change was back in August of 2024, at least over the last year or so. Ever since then, it's been going up. And now it's been increasing by about 0.15%, 0.16% for 3 months in a row. Now, the reason why I think that Bitcoin is reacting this way, and we talked about this. If you guys go back and watch the last few videos, I said that there's a really good chance, regardless of what happens, that Bitcoin will eventually sweep this low, right? Regardless of the ultimate outcome, it'll eventually sweep this low. And when it sweeps that low, it should, in the short term, at the very least, get a rally back up to the lower high structure. The reason I say that is, frankly, that's what happened last year. And also what we saw happen some in 2023 as well, where Bitcoin will set a low, eventually it'll sweep that low, and then upon sweeping that low, it'll then rally back up to the lower high structure. Now, sometimes Bitcoin is able to break through the lower high structure, and then other times it is not. For instance, last year, about a year ago, you could argue there was a lower high structure in place, not as well defined, obviously. Bitcoin was ultimately able to break through it. But again, there are times where it takes a little bit longer. And so in this case, the reason why for the labor market, good news is bad news is because if the labor market is getting tighter, then that's going to likely be a head or a tailwind for wage inflation. And if wage inflation starts to go up, then headline inflation, basically everything else will start to go up again as well. And so in that sense, for the labor market, we're in a period where good news is bad news. Because if it comes in good, it means the 10-year yield is likely going to rally. And we know that when the 10-year rallies after breaking out, Bitcoin usually struggles for a little while, especially the S&P struggles for a little while. And you can see that's exactly what happened in 2023, right? And almost the same exact setup, in fact, where Bitcoin had a rally here, and then eventually it faded back down. And then it wasn't until the 10-year topped that Bitcoin was able to begin its next leg higher. You see that? And that was because it topped for a good reason, right? It was, I mean, Yellen was issuing shorter duration, but also the unemployment rate back then was still relatively low. Even today, it's not that high. I mean, it's still only, 4.1%. But I think that's the argument in this case is that with labor market data, good news is bad news because we're in a position now where the Fed's cutting, right? If the Fed weren't cutting, you could argue that that relationship might not exist. But because we've entered into the cutting cycle, the cutting phase of the cycle, of the interest rate cycle, because of that, I think that good news for the labor market has actually meant bad news. But with inflation, it's the opposite. With inflation, good news is good news. Because if inflation drops, then that means the 10-year yield will likely get a pullback as well. And that's exactly what's been happening, right? I mean, inflation today came in, headline inflation actually went up. So you might say, well, if it went up, why is that good news? The expectation was 2.9%. So it's in line with expectations. It's not surprising in either direction, right? With the unemployment rate, it came in lower than expected. And that, I think, is what caused the 10-year yield to rise so much. With inflation, headline came in at expectations. Core inflation actually came in lower than expectations, right? If you look at headline inflation, the expectation was 2.9%. It came in at 2.9%. It is going up. And we're probably going to have to deal with that in a few months. And the market's probably going to get spooked by it in a few months. But at least for the time being, it came in at expectations. Now, if you look at core CPI, inflation rate year over year, that actually came in better than expected. Expected was 3.3%. Last month was 3.3%, and it came in at 3.2%. So it's in line with what I was discussing yesterday on Twitter or X, right? And that's that good news with inflation will likely be in the short term interpreted as good news in the market. And again, the reason is because the 10-year yield drops in this phase of the cycle when inflation is dropping. And so I think that's sort of the next question, I guess, is how long will the 10-year drop? It's hard to say exactly. I mean, you could look at a couple of different analogs, one of which is to pull up, just not even looking at an analog, but just to pull up the bull market support band, right? So, if you were to pull up, let me go back over here. I think I removed them on that page. If you go back over here, and let's just go ahead and remove all this stuff, and we will get rid of that. And we're going to switch this over just simply to the 10-year yield where we can look at its own bull market support band. And what you'll notice is that the bull market support band for the 10-year yield is right around 4.2 to 4.3%. Okay. Now, I don't know if it's going to drop back down that low, but that is where it found support out the 21-week EMA in early December. And you see that right there. It was basically a 3-week drop into the 21-week EMA. So if the 10-year yield were to continue to drop, this 21-week EMA in the short term will continue to go up. So I would say there's always a chance you find the 10-year yield back over here at some point within the next few weeks, seeing if it can hold support at the 21-week EMA or maybe just slightly above it. Sometimes after, holding support at the 21-week EMA, like it did right here, it did get a 2-week pullback right there, but it didn't actually take it back down to the 21-week EMA. So you could simply just get, rather than a drop all the way to the 21-week EMA, it might end up being a higher low that's just above the 21-week EMA. If it's to play out like that, right? If it's to play out like that, and if the labor market continues to hold up, and if inflation remains, well within expectations. So one of the things I mentioned, though, is that as it relates to Bitcoin, when it sweeps these lows, it then usually rallies back up to the lower high structure. And as I said yesterday, that would correspond to roughly 100K. Roughly 100K. In fact, if it were to happen sooner rather than later, it might even be closer to 101K. I think that the thing that Bitcoin's really going to have to contend with is, in the coming weeks, in the coming months, um, is just whether inflation continues to go up or whether the unemployment rate continues to stay flat and not go up. Because the two big things, right, the two big things that markets will be concerned about in 2025, as far as I can tell, will be, does inflation continue to go up? Does the unemployment rate start to go up? If you look back in the 1970s, again, there's sort of a similar idea where inflation bottomed out just below 3%, and then it started to go up. And as it went up, the market didn't really care. And then 1 month, it went from 3.86% all the way up to 4.83%. And when that happened, the top for the market was in, because the market then had to price in a second wave of inflation, right? You had one wave here, you had a right translated peak, or sorry, no, that was a left translated peak. You had a drop. The S&P bottomed when inflation topped, and then the S&P bounced here, but then it topped as inflation started to go back up again. And that is going to be the consideration for the markets this year. And I don't really think that it's as likely that we see a repeat of the 1970s, but the market will at least ask itself the question if that could play out. I'd like to think that we've learned our lesson back then, but there's always a chance we haven't, right? If the Fed just keeps cutting and inflation just continues to go up, then obviously we might just go through the same mistakes we made, all those decades ago, and just get another wave of inflation. But I'm hoping to remain optimistic and not see a second wave of inflation. I think everyone would prefer to not see inflation come back, as it would make it would make everyday living even more expensive than it already is. And it's already a lot more expensive now than it was back in, say, 2019, before all the money printing began. Now, if you look at inflation year over year per category, we can begin to understand, why did it go up? What's behind this recent surge of inflation, just this steady increase. Here's headline, right? Here's headline. So you can see that it's been going up since September. If you look at food and beverages, that's been slowly going up, not a lot, but slowly moving higher. Housing actually has been dropping. And you could argue that the only reason that inflation is not as higher than it is because housing makes up a big contribution. All the categories are not actually weighted the same. Housing makes up a significant contribution of the overall inflation rate, and that actually dropped. If that were not dropping, then headline inflation would be it would be much higher. But because that's dropping, it's been a good thing, to sort of drag that inflation down. Remember, housing lags. Apparel went up slightly, but not that much. Transportation went up slightly. It was deflationary not too long ago, but now it's back to being inflationary. Medical care has slightly dropped in terms of inflation. I mean, medical care prices are still going up. They're just not going up as quickly. And I think a lot of people sort of misunderstand. When I say that medical care inflation is dropping, that doesn't mean that prices aren't going up. They're still going up, right? They're going up 3% a year. It's just that it's not going up, 3.25% a year, which is what it was a few months ago, and 5% a year, or 6% a year, which is what it was going up in September 2022. So prices are a lot higher. They're just not going up as quickly. Recreation actually dropped. Education and communication dropped. Other goods and services also dropped. So it's interesting that a lot of things are dropping, yet headline inflation still went up. And one of the reasons, again, is if you look at the inflation year over year contributions per category, you have to remember they're not all weighted the same, right? They're not all weighted the same. And so, here's headline inflation. But if you look at like food and beverage, that's contributing 0.346% of the total amount, right? Of the 2.9. If you look at housing, that's basically 2/3 of it right there, right? 1.82% of the 2.9. That's essentially 2/3 of the contributions right there. I think that's the reason why, even though you see inflation dropping in a lot of categories, it hasn't budged a whole lot, is because housing makes up a significant contribution. So until housing really drops or really goes up, you might not see any major moves. by headline inflation. You can also look at core inflation and see that we actually got good news there. And remember, with inflation right now, especially with rate cuts in place, good news with inflation is good news in the market. And you can see that inflation dropped from 3.3 to 3.2%. So there's a little bit of hope, right? There's a little bit of hope that maybe core inflation will start to drop below 3%. And I think, when you're in a period like this that we've been in for the last several months since September, when I told you guys in September that the dollar would likely rally and the 10-year yield would likely rally and that the 2-year yield would likely sweep this low and then rally. We talked about it back then. You can go watch the videos. When we talked about it 4 or 5 months ago, and you've been in this phase where the long end of the yield curve is just on a massive tear higher, it looks for any possible reason to drop. Any possible one. And today you got it, right? You had inflation. It came in line with expectations. Headline, core inflation came in lower than expectations, which the market perceives as a good thing. And it is a good thing, right? I mean, obviously, we want to see inflation come back down. So now the question is what is the 10-year yield going to do? I think the argument is that, well, first of all, no one knows because it's based on data that hasn't come in yet. But I think that if inflation continues to go down, then there's a good chance you could see the 10-year yield continue to start to show some weakness. The earliest I mentioned that the 10-year yield could top out would be January. It could be later, but if you guys go back to like what I was saying in September, October, I said it would rally until January at the very least, right? And now we're going to get a new administration coming in. They're going to be dealing with, other problems now, as the markets slowly change, they're going to be dealing with some of these issues. And then I guess what we'll be looking at over the next 2 or 3 months is what is the balance, right? Does inflation continue to go up or does it stall out and start to go back down? Does the unemployment rate start to go back up or does it begin to come back down even more? And again, trying to get that soft landing that the Fed's trying to do is not an easy feat because they're constantly weighing the balances between, the rising inflation and the rising unemployment rate. And you want to make sure you're not cutting too soon, but you also don't want to wait too long. So again, it's easy for a lot of us armchair economists to sit over here and criticize every single move. But the reality is, it's now 2025. The unemployment rate's at 4.1 and inflation's still below 3. So there's at least a chance that things turn out okay. But again, we'll have to take it 1 month at a time to see where the data comes in. My guess is that eventually we do get a landing, but again, timing is everything, and landing, the landing could still be, or sort of the final part of landing could still be pretty far away, right? I mean, if you think about what happened back in the 1970s when inflation started to go back up, I mean, even here, it bottomed in January, core inflation bottomed in January of 1973. You didn't get sort of a final major crash until the end of 1974, right? So again, the business cycle just takes a long time to play out, which is why I think your investing strategy should not be based on it, right? Your investing strategy, as far as I'm concerned, my investing strategy is just based on risk levels because I can't hope to know exactly what the market is going to do on any given day. So I just stick to that. But again, if you look at core inflation, it has dropped to the lowest level that it's been at since July? Yeah, because in July it was at 3.21%. Now it's at 3.25. So it has dropped for the first time in a little while. If you look at monthly change, you can see the last, at least it was positive for the last couple of months. So now it's negative. So again, the market is using this opportunity to go up because inflation coming in line with expectations or below expectations is now perceived as good news, especially with the Fed cutting rates. And now we will see what Bitcoin does here as it approaches that lower high structure. And again, it's going to be, if it depends on when it happens, right? But right now, it would correspond to a little over 100K. If it happens a few days from now, it could be right around 100K. But I mean, you can see the chart I'm talking about right there. And again, remember, one of the things to consider is that in 2017, we found a low around mid-January before Bitcoin got a nice push for, a number of weeks. But I think the biggest counterpoint with that is there was a lot more volatility back then, right? There was a lot more volatility. And one of the things to consider back then in 2017 is when Bitcoin got that drop in January, it actually dropped to where it was in the summer of the prior year, right? Back in the 700s, right? So it rallied all the way up to, 1100, and then it dropped back down to 750. If you think about it, if you're thinking about the market today, right, it's basically just 100x that, right? Instead of a rally up to, sorry, I looked at the wrong one there. Instead of a rally here to 110, let me get it exactly so I'm not just clicking or something random right there. But here, instead of a rally up to 1,156, it was 100 times that, right? Because now you have the rally all the way up to, what was it, 108? 107, 108. And then in 2017, the market dropped to 75, which was the high from the prior summer, which is kind of interesting because, if you think about like these highs from back over here, it was right around that 75,000, 73,000. So it's not like there's definitely some similarities in terms of the actual, prices. It's just like 100x multiplied, I guess. But last year, if you look in 2023, we did see Bitcoin go down until the end of January. So there's always a chance that it just completely repeats what it did last year as well. A lot of times when you get these macro data points like inflation, you'll sort of set a new trend until the next major data comes out, right? And a lot of that is going to be in a couple of weeks, right? 2 to 3 weeks from now. I guess the first major thing is going to be the FOMC, essentially 2 weeks from today. So those are the next major events to sort of look at and see what the Fed says. And that could also be when the 10-year yield sort of finds its next true direction, right? Because the 10-year yield got a nice sell-off today, right? A really nice sell-off. And with the 10-year yield dropping, it's a good thing for risk assets as long as it's dropping for the right reasons. And remember, there's 2 reasons why the 10-year yield could drop. One is inflation's dropping. That's a good reason for the 10-year yield to drop. Another reason for the 10-year yield to drop is for the labor market to fall apart, right? The unemployment rate to skyrocket. That would be a bad reason. So as long as the 10-year yield is dropping for a good reason, then Bitcoin likely goes up. If it drops for a bad reason, then Bitcoin would likely go down. There's actually, I think I was looking at this recently. There was kind of a similar analog with the 10-year yield structure. I'm trying to remember when it was that I was looking at this. It might have. I can't even fully remember, but I had found some analog at some point in the last couple of decades. It might have been this one. So if you look right here, you can see sort of a higher high structure, right? A high and then a higher high. Similar thing right here. In between, you had a low, right? So you have this low. And then after setting this low, you then went up here, you put in a higher low. You see this? You put in a higher low right there. Same thing as right there. And then you went up and you set sort of an intermediate high right there, which is the same as that one. We came back down. We swept the low. Same thing, right? Swept the low. Went back up. Swept the prior high, right? So you have sort of a double top, a short-term double top that's a little bit lower than this top over here. And you could argue that if the 10-year yield is selling off right here, then maybe you have that same short-term double top that's a little bit lower than the top over here. And what ended up happening back then is the 10-year yield dropped to the bull market support band, I believe. And we can pull it up. See right there? The 10-year yield drops to the bull market support band, and then it exploded higher. Okay, so when it made that drop to the bull market support band in November, or really, I guess it dropped down there in November 2005. I mean, it basically hit it almost immediately. It stayed there for about a month or two, and then rallied hard for about half a year. About half a year. So my base case has been that the 10-year yield would likely top in Q1, and so too would the dollar. But that's one of those things where it's like, it's a strong opinion, but it's loosely held. If the 10-year yield were to fade here for a few weeks and find support at the bull market support band around the same level that it did back over there, then it could set up the 10-year yield to, to sort of get another move up later on this year. The market conditions are not exactly the same, which is why I struggle to put a lot of faith into some of these analogs. For instance, if you were to look at like the unemployment rate and overlay it with the 10-year yield, back over here, as the 10-year yield got that final explosion higher, right? As it got the final explosion higher, the unemployment rate, had been going down throughout that entire period. Whereas with us, this market cycle, this business cycle, the unemployment rate has been moving up. And that's one of the reasons why I think analogs can be fun to look at, and you try to use them to figure out what's the next move going to be. But a lot of times they don't actually play out to the very end, simply because the market conditions are slightly different, right? I mean, it looks the same, right? It certainly looks similar, as we just saw, but there are other underlying things going on in the macroverse that are different, right? Like the unemployment rate was dropping over there. Over here, the unemployment rate has been going up. And if you look at the U.S. inflation rate year over year, back over here when this was going on, I thought I clicked on it. Let me try again. Oh, there it is. So the inflation rate, here's the thing. That looks a little similar. Not quite, but I mean a little similar in terms of where we are, because right when the right when the 10-year yield, right when inflation, started to go back up again, that was when the 10-year yield went up again as well. Okay. So, I mean, that's kind of the question you have to ask, right? Is inflation just going to find support around just below 3%? And then get another move back up, say into the 3% to 4% range, or even the 4 to 5% range. If that happens, then you would likely see the 10-year yield go higher. But if the unemployment rate continues to slowly go up, then it would make me believe that inflation might not be as big of an issue as it was back then, and or as bad as it was back in the 1970s. That'll wrap it up, guys. Thank you for tuning in. Make sure you subscribe, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.